That is stocks in focus. Now, Zomato is the other one which is in focus. Mangalam is here with more on the same. Mangalam, hi.
Well, since morning we've been talking about water and now sugar, so perhaps food could not stay too far behind. And there's an interesting note that has come in on Zomato this morning from Jefferies. They've compared Zomato's metrics with Swiggy because Process, which is an investor in the tech, they've made a release and that points to a market share loss for Swiggy. Zomato's market share now for the first half of this calendar year stands at 55%. And that's an important metric to watch out for because, you know, everyone is looking at this market as a duopoly between Zomato and Swiggy. As far as the first half revenues are concerned, for Swiggy, the revenues have been 40% higher, whereas the same for Zomato has been 55% higher. And this is purely for the food delivery business. Swiggy's Instamart has done much better. But overall losses for Swiggy in the first half have been $315 million, whereas for Zomato, they've been curtailed just to around $50 million odd. So what does this mean going forward? Jefferies says that for the near future, they see a possibility of a modest growth in the coming months for the food delivery sector. But, you know, added to that, the losses of Swiggy, it may also mean a strong case for Swiggy actually dropping its aggressive competitive stance in food delivery. And if that was to happen, it would be a big positive for Zomato. Because, you know, Zomato from the lows has rallied about 52 odd %. And at the same time, fundamentally as well, the management has been speaking the right things. They've been saying that the food delivery business also turned EBITDA positive in the second quarter. So with all these things, reducing competition could only be a bigger positive.
Okay, thanks a lot for that, Mangalam. That's on Zomato. By the way, the market